Hello everyone, welcome back to my channel. I'm Debbie Lee here with the White Samurai Investment Group today. And today we are going to be diving into a topic that is quite intimidating, but absolutely necessary. We're going to be covering the areas of investing, specifically how to actually understand everything an investment company sends and says to you. So we're going to be breaking this down through 4 major areas that definitely confuse a lot of beginner investors that I've seen anyway. So a lot of these confusions really keep a lot of working class people from feeling confident about investing. So we are going to be covering how to understand the jargon that investment companies use, what to expect in your first 3 months of signing up, how to read client reports, quarterly updates, and market notes, and how to properly read and understand a portfolio breakdown report. So I've kind of written these down here. Can you see that? So I'll take some notes and hopefully I will remember to hold them up at the end of the video. So anyways, over this past year, I have watched a pattern play out again and again. Someone finally takes the step to invest with a firm, but they're nervous, but they are hopeful. They fill out all their risk profile, transfer their first amounts, and then read the documents that start coming in. All of the updates come in as well. The investment team starts talking about allocation, rebalance and triggers, and macroeconomy exposure, overweights, underweights, benchmark deviations, year-to-date volatility, NAV, liquidity stress, annualized standard deviation, and 100 other different ways to talk about quite simple terms. So all of these terms kind of make the average beginner feel like they've accidentally signed up to pilot a space shuttle. So I have watched incredibly intelligent, disciplined, hardworking people that run entire households, people who manage budgets like absolute machines, people who keep families and businesses functioning, and they all just freeze up because of one simple thing. The language that investing is designed for insiders, not for the everyday person. So here's what I've learnt. I have learnt, this is why today's topic is extremely important. I have seen when the working class understands the language of wealth, the gatekeeping collapses. So when you can read the report, when you can understand the jargon, when you can interpret a market note or understand what's happening inside your portfolio, nobody can take advantage of you. Nobody can sell you something that you don't need. Nobody can confuse you into staying dependent. And nobody can make you feel not smart enough. So today we're going to be breaking all this down in a way that's so simple and understandable and empowering. I'm not going to treat you like a child, these terms are I'm not going to over dramatize anything. So the goal here is just mastery. So the goal is clarity, And the goal is building you into someone who knows exactly what's going on with your money, not someone who just hopes for the best, because an investment company said they'll take care of it. So by the end of the video, you will have a clear understanding of what investment jargon actually means and why companies use it, what your first 3 months with an investment company should realistically look like, how to read monthly or quarterly reports with confidence, how to interpret market notes without panicking or confusion, and how your portfolio breakdown like someone who has been investing for years, how to analyze your portfolio breakdown, and also how important that you're going to feel, because everything you will understand and it'll empower you more, because money is power, sure, but understanding what keeps that power in your hands. So before I get into the 4 topics, I'm going to start with the story, obviously. So when I first joined White Samurai a year ago, I remember sitting on a call with a client, and we'll call her Maria. So she was in her early 40s. She worked a couple of jobs. She had 3 kids. She was supporting her elderly mother as well, and had finally saved enough to invest for the first time. So she was definitely capable. Like, she was organized. She was the kind of woman who makes impossible things look very structured and routine. But when she first opened her first client report, she absolutely lost it. She panicked. She looked at the pages and saw the words like asset class rotation, equity overweight, bond allocation, deviation, emerging markets exposure, hedging position, and rebalancing tolerance bands. So the numbers were small. The charts were literally everywhere, and she felt like she was looking at an encrypted code, and she didn't want to ask questions because she felt embarrassed. So she just assumed that everyone else got it and understood except her. But here's the truth. Nobody gets it at first, obviously. You have to learn all of these things. Even people who have been investing for a decade only understand a fraction of the language investment firms use. So after the call ended, I sat with her for nearly an hour and explained everything. I broke down all the charts. I showed her how to read allocations. I translated every piece of jargon into simple layman's terms, simple everyday language. And I watched her shoulders just drop. She was so tense during the beginning, but then she just relaxed because she realized that you can just ask questions. You can just ask. So she did look relieved, but she also looked a little bit angry. And what did she say? She said, if someone had just explained this earlier, I wouldn't have felt stupid for the last 3 months. And it kind of caught me off guard a little bit, but look, it's a 2-way street. I'm still learning, and I'm still trying to undertake how to communicate things with people that they don't understand, because you don't know what you don't know. Just like me, I don't know if clients know what I'm talking about or not. But Maria wasn't stupid, she was just unfamiliar, and she had never been taught the language of investing. Nobody in her family invested, nobody around her grew up discussing ETFs or interest rate policies over dinner. She wasn't raised with wealth habits or investing conversations either. And she definitely wasn't raised in a world where financial literacy was normal. Her world was like so many working class people that they were taught to work hard, pay your bills, stay afloat, right? Like just last. And that is how so many people are just kept out, not by lack of intelligence, but lack of translation. So a few weeks after our meeting, she called me again, and this time she sounded different. She was definitely a lot more confident and relaxed. And she said, I got my quarterly update today. And what did she say? She understood it all. She was like, yeah, I actually am looking at the charts and understanding what's happening. And she could read every term and kind of translate it into like a realistic perspective. And that's when I kind of understood what was happening. I understood that understanding is what creates belonging. Financial jargon isn't just confusing, it's exclusionary. It tells you this isn't your world because you don't know what this word means. You have to stay in your lane. If you don't know what it means, then you shouldn't be talking about it. You shouldn't be asking about it. So she started feeling like an investor, and that's exactly how we want clients to feel. And she definitely felt like she started to belong, right? Because she understood she could have casual conversations with people in her life now and like still use the words, but also explain things to other people that she knows doesn't understand those jargon. So Maria's story ended really nicely and peacefully. So she now invests monthly and she understands everything that she receives, and she teaches her eldest son how to read all the reports as well. So she told me that day that she explained an allocation chart to him, and that was the day that she realized she had broken a generational pattern. So she was like, my kids won't start behind like I did, because they'll like understand what I'm talking about. And that's exactly why this topic is so important. So today I want to give you the same language, because when the common folk understand how the wealthy operate, we close the wealth gap. And when we learn all the rules, we stop getting played as well. When we gain the knowledge, we gain the power. So that is how we come to topic number 1, how to understand the jargon investment companies use. So investment companies love jargon. They use it internally, externally, and sometimes unnecessarily, but there's a reason for it. The financial industry grew out of academia, banking, institutional investing, and economics. So each field brought its own vocabulary. Over decades, those vocabularies merged into a dense, technical, intimidating language. But most jargon terms describe very simple concepts. So below is a breakdown of the most common ones that you will encounter as a beginner. So I will try to make all these fit on here. Allocation. So what is allocation? This simply means where your money is spread across different types of investments. For an example, your portfolio might be allocated like something with 50% stocks, 30% bonds, 20% cash, so that is your allocation. So investment companies like to use words like balanced allocation, conservative allocation, or growth allocation. So what these really mean are how much risk, how much safety, what mix of assets you have. Number 2, the asset class. So an asset class is a category of investments. So they might be stocks, bonds, real estate, commodities, cash, ETFs. So when a company says your asset class mix, they mean the combination of all of these buckets. So I will write that down. Asset class. Diversification. Now, we have heard this one a couple of times on here, and it is kind of the most used kind of entryway for investment talk amongst working class regular people, right? So it's just a fancy word for not putting all of your eggs in one basket. Not putting all of your money in a single stock, in a single asset, in a single market, in a single country, you know? You're diversified just means your portfolio is well balanced amongst different things. So the risk to reward ratio is balanced. So you're diversified, you have diverse coverage. So that brings us to equity. Diversification. Equity. So equity just means stocks. So if your report says equity exposure, it just means how much money you have in stocks. Fixed income. So this is just code for bonds or interest rates investments, interest-based investments. Fixed income. So that is how much money you are receiving at the end of the day. So when they say fixed income allocation, they are talking about the position of your portfolio designed to provide stability and regular income. Number 6, overweight versus underweight. So this just, it sounds quite dramatic, but it's simple. So overweight, what does that mean? You have more of something than the average. Underweight means you have less of something than the average. So as an example, if the S&P 500 has 20% tech, but your portfolio has 30% tech, you're overweight tech. And the benchmark is the average. So a benchmark is the comparison standard used to measure your portfolio. So think of it like the average score you compare yourself to. So if your benchmark is the S&P 500, the company will say things like, your portfolio outperformed the benchmark this quarter. Rebalancing. So this means adjusting your portfolio back to its original mix. So if stocks grew too fast and now make up too much of your portfolio, the company may sell some stocks and buy bonds to restore balance. Market volatility. So this simply means ups and downs. When they say the market experienced elevated volatility, they just mean the prices moved a lot in a short period. And the NAV. So this is just net asset value. So this is used for funds, not individual stocks. It means the value of one unit of the fund. So think of it like the price tag. Liquidity. I might write that one down. NAV. NAV. Liquidity. So the liquidity is how quickly you can turn an investment into cash. So they may say low liquidity environments, meaning it's harder than usual to sell certain assets very quickly. The yield, you may have heard this one before. It's a word used generally in a lot of different places. So this is another word for income you earn from an investment, usually from interest or dividends. The annualized return, this means taking your total return and expressing it as a yearly average. The drawdown, a scary sounding word for how much your portfolio dropped at its peak. So why do companies use jargon? Because it's efficient for professionals, it signals expertise, it standardizes communication. Legally, some terms are required, and clients assume complex words equals complex skill. But now you know all the translations, which means that you have the power. Should I write that last one down? I think I won't write yield, annualized return. I might write drawdown. Cool. So these were kind of the most non-average terms. So this brings us to topic number 2. What should you expect in the first 3 months after signing up with an investment company? So your first 3 months with an investment company are crucial. They set the tone, they determine your experience, and they shape whether you feel informed or lost. So here is exactly what should and should not happen in that period. So the first month, you want to be set up, you have onboarding and first allocation. So what should happen in the first month? You complete a risk profile, which is aggressive, balanced, or conservative. You provide identity documents. You transfer your first deposit. The investment company builds your portfolio or assigns you a model portfolio. You receive a welcome pack or onboarding documents. You receive a clear explanation of the strategy. So, what you should expect. So you should expect clarity around fees, clarity around timing, clarity around performance expectations, clarity around communication channels. So what may you feel during the first month? You should feel very excited, a lot of anxiety, definitely second guessing, fear of losing money, uncertainty around what happens next. All of these feelings are normal. So the second month, what should happen? You receive your first monthly or quarterly update. Your portfolio begins to fluctuate up and down. You receive explanations of market conditions. You start learning the structure of your portfolio. So what should you be looking out for? You should be looking out for how transparent the company is, whether they explain performance clearly, whether they answer your questions patiently, whether the communication style feels grounded, not salesy. So what might you feel? You might feel uncertain when you see your portfolio drop. You might be a little bit confused about the charts. You might be curious about next steps. So this is all normal. And I do want to say, if you've got a notepad somewhere or you're using your phone, you use your phone mainly in day-to-day life, definitely create a little section in the Notes app or the Reminders app, whatever phone that you use. And every time you don't understand something or you question something, definitely just write it down. So then when you come to your appointment or you have the opportunity to ask the investment company, just ask them all the questions. So then you don't have to like overload them with one question at a time. Do you know what I mean? So the third month, there should be understanding, stability, and confidence building. So what should happen? You should receive your first official quarterly report if it's applicable to you. So you see long-term strategy in writing. You start understanding how performance is tracked. You receive a clear explanation of any rebalancing done. You may get invited to webinars or educational sessions as well. So by the end of the third month, you should definitely feel a lot more grounded, less afraid of the volatility, confident in reading updates, familiar with the language, aware of how your portfolio is behaving. So what should not happen? There shouldn't be any pressure to add more money. There shouldn't be any pressure to upgrade your account. There should be no vague or empty answers. There should be no refusals to explain anything. And there should be guaranteed return claims. There shouldn't be guaranteed return claims. And there shouldn't be any of your questions that are being ignored as well. So, why do the first 90 days matter so much? Because this is when beginners either gain confidence and stick with it long term, get overwhelmed and stop investing together. So the industry knows this, right? This is why many firms use complex language early on to increase the dependency. But today you're learning how to break that cycle. So let's move to topic number 3. Understanding, I didn't really write anything for that topic actually. Anyway, so topic number 3, understanding client reports, quarterly updates, and market notes. So, client reports look very complicated, but they follow predictable structures. Once you understand the sections, everything becomes clear. So, the first one that we're talking about is the cover page. So this normally includes everything like your name, the reporting period, the name of your portfolio, a quick summary of performance. So nothing complicated, just a snapshot of general things. So, should I write that down? Cover page. covered page. So the next one is portfolio performance. That was a big one. Portfolio. Performance. So this section tells you how your portfolio performed, obviously, how that performance compares to the benchmark, what type of return you receive, so the growth or the income. So a couple of common liners that investment companies might use are portfolio return, benchmark return, performance relative to benchmark, year-to-date return, since inception return. So how do you read it? So if your portfolio return is close to the benchmark, your portfolio is behaving normally. If it's far above, the portfolio took more risk or the strategy worked extremely well. If it's far below, the allocation might be more conservative than the benchmark. So contributions and withdrawals might sound quite simple. Shortened that word. So a simple list, the contributions and withdrawals should include a simple list of how much you invested, any withdrawals, and the total portfolio value. So this prevents confusion when returns fluctuate. Number 4, the asset allocation. So this is usually displayed as a pie chart, a bar chart, or with percentages. So this is where you see the stocks, the bonds, the cash, the alternatives, the regions, the sectors. So the goal of this is to understand what your money is actually invested in and how many of each sections, cover your whole portfolio. So the 5th point is the holdings list. So this lists exactly what you own, the ETFs, the stocks, the funds. So you will see columns like the weight percentage, the value, the performance, contribution to returns. So the weight is how much of your portfolio is allocated to that investment. The contribution is how much that investment added or subtracted to the overall performance. So market commentary. So this explains what happened in the economy. Let me write that down. Oops. Market commentary. So how the markets responded, the key drivers of performance, major global events impacting your portfolio. So you'll see words like inflation, central bank policy, geopolitical risk, economic growth. So don't get intimidated. They're just explanations for why the market moved. So outlook season. So this outlines outlook season. So this outlines how the firm expects markets to behave, what risks they anticipate, what opportunities that they see, how they're positioning your portfolio. So just remember, this is not a prediction, it's a strategy view. So the market notes. Okay, that's the last section. Oops, did that again. Market notes. So the market notes are shorter, with more frequent updates. They usually include the market movements, major news, short-term volatility, reassurance that the long-term strategy is intact. The goal is to keep you informed so that you don't panic. So how do you read these confidently? So you just want to focus on the key sections like performance allocation and the commentary. You want to translate jargon into simple terms. You want to compare your portfolio to the benchmark. You want to ignore overly complex sentences. They're often just fillers. You want to ask questions if anything feels unclear. So, how to read, this brings us to topic number 4. So, how to read a portfolio breakdown report. So, a portfolio breakdown report is like the blueprint of your wealth. It tells you exactly what you own, why you own it, and how each piece works. So, steps. So step number 1 for reading a breakdown report is start with total allocation. So should I section that off? Just go number 1. Section. That's not section. Oopsie. Total allocation. So the report usually begins with the total value, the total change, the risk category, the asset mix. So you want to ask yourself, does the allocation match my risk profile? As an example, if you're conservative, you should not see 80% stocks. Step number 2, review the major categories. How many steps are there? Hold on 1 second. Okay. 9. Okay. I'm gonna Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. So number 2, you want to review the major categories. So you will see categories like equities, equities, for example, stocks, fixed income, could be bonds, cash, alternatives, international versus domestic exposure, sector distribution. So what you're checking for is balance, diversification, and appropriate risk. So step number 3, look at regional exposure. Regional exposure. So if your report shows 60% US, 20% Asia, 10% Europe, 10% Australia, this matters because different regions move differently. If one region dominates your portfolio, understand why. Ask why. Number 4, sector exposure. So some sectors might include technology, healthcare, energy, financials, consumer goods, industrials, agriculture. If tech is too high, your portfolio is more volatile. If bonds dominate your portfolio is more stable. So step number 5, individual holdings. So each investment will have a name, a ticker, percentage weight, the gain, the loss, the contribution to return. So what do you look out for? You want to look out for, are any weights unusually high? Are you overexposed to one company? Are there multiple investments doing the same thing? Did I write that one down? Yes. So risk indicators. So some reports include volatility, drawdown, risk ratings. So you don't need to be an expert. These simply just tell you how bumpy the ride may be. Step number 7, fees and costs. So this section is crucial. The ampersand. fees and costs. So you want to check definitely the management fees, performance fees, fund expense ratios, trading costs. So fees should be transparent and reasonable. Step number 8, cash position. So you may see something like cash, 5%. So this is used for stability, opportunities, covering withdrawals. And finally, number 9, rebalancing notes. Okay, so if the firm adjusted your portfolio, they will explain why. So this might say reduced exposure, increased allocation, trimmed position, added defensive assets. So each of these means that they shifted your mix to maintain the balance. So I won't write this down, but the 10th step is to ask yourself questions. Do I understand what I own? Does this match my profile risk? Is the portfolio diversified? Is the strategy clear? Are fees reasonable for me? Does the firm explain performance well? If the answer is always no, just ask them. Ask your advisor. Make a note of everything that you don't understand, and then when it comes to visiting them, calling them, whatever it may be, emailing them, you know, like getting in contact with them, then you can send them all the questions in one go. So understanding your reports is not optional. It's your right. So if all of this made sense to you today and you feel more empowered, just remember this. Understanding is the foundation of long-term wealth. At White Samurai, our mission is to make sure everyday people, especially the working class families, have access to the knowledge that the wealthy have used for decades. If you want personalized support, clearer reports, transparent strategies, or education without the jargon, reach out to us at White Samurai, or leave a comment on this video, or message me directly, because you deserve to invest with confidence and clarity. So, as a summary, to cover everything that we covered in this video, we definitely covered the core essentials that any beginner needs. So we now understand how to understand investment jargon, what to expect in the first 3 months of investing with a company, how to interpret client reports and updates, and how to read portfolio breakdowns with confidence. So all of these tools ensure that you stay informed, empowered, and in control of your wealth journey. So when you understand the language, you control the outcome. And I will show you the notes. so I just want to thank everyone definitely for making it this far. Please don't forget to leave a like, a comment on this video, what you liked about this video, what you didn't like, any tips for my channel, anything that you can think of, any topics that you want me to talk about in the future. Leave a comment, message me directly, but definitely check out the White Samurai Investment Group's website. I will leave it linked in the description below, and please check them out. Head to their YouTube for any specific detailed topics. They have a lot of different playlists on their channel, so definitely check them out. And if you've got any questions directly for them, head to their website. They have a form that you can submit with any questions that you have. And yeah, or you can message me directly, and myself or the team will do our best to get back to you. And until then, I hope you like this video, and I will see you in the next one.